decisions. So once again, thank you for joining. It's 7:30 today. It's gonna go on for at least 1 or 2 hours today. So thanks for taking your precious time to attend this event. We have quite a number of registrations and a lot more people are joining in. We have Ashish from Oswald Buyers Agency. He's a buyer's agent. And if you don't know me, my name is Rahul. I'm from Fin Matters. I'm a mortgage broker. And with us today, we have a really special guest. His name is Ash Jindal. You would have seen him before. If not, he will show what he can do today. He is not only a tax accountant, but one of the only few people who also has financial advisory license. Is that right, Ash? I think you're on mute, Ash.
Thank you. Yes, I do. I do.
No, that's great. That's great, Ashley. So, Ash, if you can just like let us know a little bit about yourself so people have some context, how long you've been doing this, what you do. People who don't know who you are, obviously they might have seen you on YouTube or the social media, but please.
Absolutely. Now, thank you very much, Rahul, and thank you, Ashish, for giving me this platform. Very, very excited and very happy to introduce the budget or the budget changes to everyone. On a lot of it's more like a discussion. Obviously, we can do heaps of time for Q&A. My professional background is I'm a chartered accountant from Australia, New Zealand. I'm also a registered tax agent. I'm also a registered financial advisor. I run a practice called Clear Tax. We are 102 people we are 102 people in the firm now, approximately present in 6 locations, including Sydney, Adelaide, and Victoria, that is Melbourne. Yeah, so that's pretty much it. Look, we are very well versed with when it comes to property taxes and stuff like that. So hence this is a topic that is very, very close to me. And once asked, I was like very, very keen. Yes, let's do this. So back to you, Rahul.
Now, all good. Ashish, what what thoughts do you have about this? Please share with us.
Nothing much. You can't find a perfect property generally, but you've got a perfect team here. Where I'm really keen to start, and I'm really looking forward to ask all the questions that most of the chats happen over barbecues, and I think friends and family are the worst advisors. No offense meant to anyone, but I've seen them actually ruin the deal. And my business coach says it's always the nearest ones that'll pull you back because of their own limitation and notions. So believe or not, I've seen business owners and highly effective sports personnel who do the mindset training so they can remove their cognitive blocks or mental blocks, notions. So let's not get into that and listen to what Ash has to say, who's a licensed financial advisor and a tax advisor. So I'm sure he'll be limiting and be very careful in what he advises. So this is not a financial advice, neither a mortgage advice or a property advice. Make sure you consult your personal situation to the respective professional. It is all general in nature. And I'd also like to convey my regards to the elders past and present. To that, Ash, over to you.
Thank you so much. If I can share my screen, then let's get started. Again, guys, the agenda is not to bore you. I know theory can get boring, so we'll try to keep it as interesting as possible. Try to limiting the speaking time that you have allocated to us, probably of 15-20 minutes or less than 15 minutes. And then going back to Q&A, and then 45 minutes can be allocated to Q&A, and then you can ask as many questions as you like. I will be running past through. I have like 50 slides. Me and Rahul sharing about 50 slides. So we'll try to run past through so that we don't bore you. The good thing is by now, a lot of people have already have a lot of knowledge for the budget. So we'll try not to repeat ourselves and try not to again to bore and just to give you the same information over and over again. We'll try to keep
just while we get started, Ash, just 1 second, I will just give a disclaimer to everyone that you can start posting your questions in Q&A because we will just start by first in, first out questions. We have a list of questions already there. So if you have any, just post in the Q&A section and we will take all of them at the end. And if our voices are cracking, if anything is, if it's glitching, just let us know as well and we will try to improve that.
Easy busy. Let's get started.
Let's get started.
Okay, so a disclaimer, we're going to talk about budget, but please ensure and please do remember the budget is a budget only right now. It's not law. So any decision you make after this, it's not going to be relevant because unless you're not waiting for this to all become a law and then make a decision. And one more thing I must remind that, government is kind of giving about 3 years to change structures as well. That is also proposed in the budget. Hopefully, that will also become a law with everything else, which means even if you end up creating a structure which probably is not right, hopefully the government will end up, will give you an option to change that. Okay, so do not panic and do not act just basis this presentation or anything that you hear in the news. Wait, read, and then probably act on it. Right. Okay. Obviously, the budget we're going to address or has addressed three major changes that we're going to talk about all three: negative gearing, capital gains tax, and trust. All of these are extremely relevant for any property investor or any savvy property investor in the market right now. So these three are the big changes. I mean, there are other changes related to small businesses, which we're not covering today, just focusing on property investors only. Hence, negative gearing, capital gains, and the trust changes are going to be discussed, right? Let's start with the first one, which is negative gearing. So lot of talks on negative gearing, but let's understand in like 10 seconds what is negative gearing. If my rental income, with an example, if my rental income is 35K and my total expense for that property is 49K, that means my property is making a loss of $14,000 every single year. And that is what is called negative gearing. Okay, so basically, if my property is making a loss, that's a negative gearing. What I can do with that loss, generally, it's unlike other countries. In Australia, it's so beautiful. Up till now, you are able to offset this $14,000 against your PAYG income if the property is held under your name. So that means if someone is earning 100K salary and they have $14,000 of negative gearing from the property, that means that taxable income is only 86K. How beautiful is that? So basically, they claim the tax back on $14,000 of negative gearing. So this is what government wants to stop, and what government is trying to push is property losses can be offset against the property gains only, which means if you're gonna from 1st of July 2027, if you're gonna have a negative gear property and that property has to be bought after 12th of May 2026, that is 7:30 p.m. 12th of May 20. If you are following to the new rules, and if this become a rule, any property that you bought after 12th of May 2026, from 1st of July 2027, you won't be able to claim negative gearing against your PAYG income. You will still be allowed to claim negative gearing in the future. That's the property gets negative gearing gets quarantined, and as and when the property starts making money, you can offset all the negative gearing in the future. That is there. But the only thing is you won't be able to claim it against your PAYG income. As simple as it, in simple terms, the negative gearing. Okay. We can skip that one and over to Rahul.
Yes, so I would just quickly discuss what are the changes for the borrowing capacity part. If my voice is not clear or it's cracking, just let me know. I will try to be a little bit louder and clearer. But these, like negative gearing in terms of borrowing capacity, if you buy under a personal name, is also an add back because it's technically your income is going down. Then we can add it back in terms of whatever tax advantage you are going to get. So that used to boost the borrowing capacity. So maybe this is not the slide. Is there a different slide where we can show the before part? Yeah, maybe just scroll down in this. We will find one which is going to be the before part of borrowing capacity. And then we will see what was the borrowing capacity before the changes happened. And we will also see what is the one, what are the changes. Yes, this is the one. So with the major big fours, this is what, let's say, traditional borrowing capacity was like. Let's say if you were able to borrow million 60, for example, with ANZ, million 58 with Westpac, NAB, Commonwealth 964. After the negative gearing changes, which we can take it off discount, now the new borrowing capacity is nearly 25% less. So you can see with ANZ and Westpac, we can borrow instead of 1.06, 1.05, 740-ish. With CDS, same changes, and with NAB, the same changes. Westpac has not implemented it yet. They are saying that we will wait until the budget is passed as a legislation, but most of the other lenders have already made this switch. Here on, this is what your new borrowing capacity would be if you keep buying under the personal names, existing property, not a new build. Again, this is the small differential. If you buy a new build, whatever new builds are, we will cover that later in this webinar. Ash will cover that. But this is what changes in your lending. Now that you know your borrowing capacity, and this is like what it is with majors. Some tier 3 lenders again show have this much higher borrowing capacity after the changes. So ANZ is offering you 750, for example. Then you can see if Resimac is offering you 1.04. MA Money is offering 860. Liberty is offering 830. So you can still get a little more under the personal lane if you are stuck by going to these lenders. Good option. Some of them have really good rates as well. But then again, these things are not cheap and these lenders are not cheap. They may have slightly higher rates, but it gets you the solution. It gets you in the market or gives you the boost that you need for borrowing to buy the property that you want. Now, again, once you know that your borrowing capacity is this, the question comes down to for most investors that should they buy a new build or an existing? And if they're buying a new build or existing, what structure should they buy under? Is it going to be a company? Is it going to be a trust? Because now that the negative gearing changes are gone, the incentive to buy under the personal name is also less. It's more about preserving that borrowing capacity. And how does a company or a trust preserve a borrowing capacity from lending point? It's that when that company or a trust, when that property that you have bought under that has become self-sufficient, which means the rent is covering all the expenses and in the repayments of this, then we can exclude that from your borrowing capacity again with a certain lenders. So once we do that, your borrowing capacity of $800 million, or whatever that is, comes back again because we have now a certified accountant or your tax returns to show that this trust is self-sufficient. We don't need to put that in your borrowing capacity, and you get it back faster than if you had to put it under your personal name. So this is how the lending works in company and trust. Why should we do this? But now getting back to Ash, and he will cover off what are trust like, what are the different changes, impacts of this, and what are new bills and all the following topics.
Thank you, Rahul. Right here. So as per the proposed rules, as we talk about negative gearing, obviously they're disallowing the negative gearing. So that means if someone has a salary income of 180K and they have a rental loss of 15K, before the taxable income is 165, now the taxable income remains to 180, and the $15,000 quarantine for that property to carry forward in the future to be adjusted against the future income. Okay. Again, keep on dropping your FAQs in the chat box, and then we can pick it up one by one as they go along, so that you don't forget to even ask that question. Okay. Grandfathering rules, which are very, very popular. So people who already hold the investment properties and which are negative geared, I mean, almost most of the properties are negative geared right now with the interest rate or the craziness that is going on in the market. What government has said is you can still continue to negative gear those properties. That also means now just I'm not an economist, but just my gut feel, there will be less and less people selling those properties in the future that are negative geared, because they would feel like they're losing out for a deduction forever. Because once the property is sold, then it's sold. That's gone. But so negative gearing is not transferable to the new owners. So that's why probably people who are holding a negative gear, maybe they will want to hold. But overall, what I'm saying is, anything that you already have before 7:30 p.m., 12th of May, 2026, that was a negative gearing, you can still negative geared. Another question I generally get is, if I have a PPOR and if I'm before 12th of May 2026, and if I do make that as an investment property, can I still claim the negative gearing? To what we understand as of now, again, these are not rules yet, budget proposal only, with the limited information, what we understand till now is, yes, you would be able to negative gear that PPOR in the future if you already hold the PPOR on 12th of May 2026 and then become your investment property after 12th of May 2026. Okay. Right. So there are some exceptions, and basically what government is saying is we are doing all this to promote the new builds, and the exceptions are, if you do invest into a new build, that means if you are planning to buy a new home, newly constructed home, then yes, you can still claim the negative gearing against your PAYG income. Okay. Eligible new builds are off the plan, new build townhouses, vacant land construction when there's a vacant land, vacant plot, and brand new dwellings as well. It is possible for someone to abolish a dwelling and then construct more than one dwelling, that is 2 or 3 or 4 dwellings onto that land. So that then they are allowed to claim the negative gearing because they have instead of creating one-to-one dwelling, they have created more than one dwelling. That means more housing needs are met for Australians. Okay, and obviously there are stuff like renovations, granny flat, existing home, cosmetic upgrades. All this is not a part of eligible new builds. That means even you may do all this, but you won't be able to claim negative gearing against your PAYG income going forward. As I said, obviously duplex townhouses, multiple dwellings is a new build. Okay, when you abolish a old home and replace it with brand new shiny home, that's not a new dwelling for negative gearing purposes, because you have not added a dwelling into the Australian market. You have just abolished and created a new one. But if you demolish and create 2-3 townhouses, then yes, absolutely, that is part of. Okay, knockdown rebuilds do not qualify as an exemption. Obviously, there are all these rules, but we're talking about, guys, not to forget, all these rules are primarily targeting established residential property, but they're not targeting a commercial property where negative gearing is still allowed. Shares, managed funds, any other assets, they're not really. Only you're not allowed to claim negative gearing against established residential property, which means if someone borrows the money from the bank and invest into shares, probably they would be still allowed to claim negative gearing on the shares. Yeah. So it's not, they're just targeting established residential property, which existed before 12th of July, 12th of June, sorry, 12th of May.
And Ash, I'm not sure if it will be covered, but ideally negative gearing has not been removed. It has just been contained, right? So,
Yes.
And will that be covered as well?
Yeah. So I've mentioned it a few times already that
Okay.
negative gearing, it's quarantined within that property. So which means if the property is $15,000 negative gear, yes, you cannot offset it against your income, but you can carry forward that $15,000 over and over as and when that property makes money, whether you sell the property or you have a net rental income. First, all the negative gearing get offset, and then you end up paying taxes. Okay. Right, so this brings to the second topic, which is capital gains tax. Again, guys, as we talked about, there are 3 topics we're going to discuss today. One is negative gearing, another one is capital gains tax. So we are on second topic, and then the third topic will be trust. So we are on capital gains tax now. Okay, so let's understand what the current rules are, and then we'll understand the change. The current rule are, if you invest into an asset, and if you hold that asset for more than 12 months, you get a 50% CGT discount. To explain this, let's take an example. If I purchase a property of 700K, I sold it for 1.3 million. That means I've made a gain of, let's say after 10 years, I've sold it for 1.3 million. I made a gain of 600K. Only 300K of that gain is taxable. 300K is fully exempt. So that means if I hold this property at an individual name, it says my name, the 300K of 600K will be added to my income, and 300K is fully exempt. Okay. So if I'm on a top end tax bracket, what it means is I'm only paying 23.5% of effective tax rate. That is 50% of 47%. So I'm technically maximum tax rate I end up paying is about 23.5 on this gain. Okay. However, what they're saying is we're going to abolish this 50% discount altogether, and we're going to introduce a 30% minimum tax when you sell the property. What it means, if I hold the property, it's a similar case. If I hold the property in this case, the 600K gain, minimum tax I have to pay is 30%. Yes, the 600K will be added to my income. That is true. But minimum tax, no matter what goes on in my life, minimum tax is 30%. And that's where the bracket is going to start. So again, a lot of calculations can be done, but this is applied to individual, trust, and partnership. And ironically, obviously, and we'll understand it in a minute, why companies are not part of this 30% minimum tax, because companies by default are taxed 30%. So probably that is why the companies are not part of this, because right now as well, if you invest in a company, so many people would come around and say, oh, the companies are taxed at 25%. No, that's a trading profits. So we're not talking about trading. When you are setting up an investment company, they are taxed at 30%, not 25%. So companies are already at 30% tax bracket, and that's why probably they've left out. Now, one beautiful thing that government has introduced, so obviously they gotta give something with the 30% of flat tax. What they have introduced is indexation, and we'll discuss that in a sec. But indexation is so magical that it cannot be ignored. The one important thing to understand here is as well, individual, trust, partnership, probably gets indexation, whereas companies do not get indexation. And that makes a huge business case that why people are buying or attracted towards individual or trust, and why they're not attracted to hold properties in the name of company. Okay, so as I said, simply what government is trying to do is they're trying to push you away from 23.5% of max tax to 30% tax-ish. So when you do modeling, when you do various examples and this and that, you will find government will be better off about 6 to 7%-ish in most cases. Say, for example, if they were getting, I don't know, if they were getting, so they've just increased the taxes by 6%. So technically, what 20% of the tax is going to go up when you are now selling the property in the future, ish. Okay. Indexation, as we talked about. Anything that you can buy today for 500K, let's say a piece of, let's say bread, you can buy for $10 today or $4 today, probably in 10 years time, the price is going to go up to 650. So what is that? That's a CPI. That's an indexation. The cost of living has gone up. So what government is saying is we realize that your property that you buy today for 500K may be worth lot, may needs to be indexed over 10 years because the cost of living has gone up. Okay, so this is what the indexation is. So basically what they're saying is, if you buy the property for 500K, if we give you an indexation, and let's say with the help of indexation, the cost base of that property, the cost base of that property can be increased to 700K. And if you sell that property after 10 years for $1 million, you're not reporting a gain of 500K, you're reporting only a gain of 300K because the property has gone up, the cost base of that property has gone up by 200K. We'll see that in example just in a second. Okay, here it is an example. When I've taken, maybe again, these are just rough calculation. ATO will tell you how to calculate the indexation and stuff. But if I buy a house for 500K in 10 years time, let's take a 3.5% indexation, the cost base can be reset to 705K. And if I'm selling this property for $1 million, I'm not paying taxes on 500K, I'm paying taxes on 295K. So you see, this is the difference. Now, companies do not get this indexation. Only trust and the individuals in prime examples that will get indexation. Okay. In 20 years' time, the cost base can be 995 with 3.5% indexation. I think we have already talked about it. Cost base, again, something that is 500 today, with the help of indexation, the cost base can be revised to a higher amount in the future. And this is a good thing for you because you pay lower taxes. Now, please do not assume the cost base is just the purchase of the property. It also includes the stamp duty, the legal, the conveyancer fee, the buyer's agent fee, the title search, the building and pest inspection, the mortgage registration fees, transfer fees. All these fees are part of your cost base, which gets indexed. Okay, not just the property purchase price. We can skip that one. That's okay. Selling property. Yeah. Okay. Let's talk about what happens if you sell the property after. Okay. So in a very brief example, if I buy the property in 2020 and if I sell it in 2030, the rules are changing from 1st of July 2027. So what does that mean? Part of the year, or part of this 10 year, which is approximately 7 years, I will be calculated as per old rules, and for the next 3 years, I will be calculated as per new rules. So the accountant will work out how. So if when you're selling it, your accountant can easily work out, or should be able to work out, how much of this tax is paid as per old rules and how much of this tax is paid as per new rules. So basically, they will pro rata it. So 7 by 10 will be old rules and 3 by 10 new rules. Again, there are two methods to it. One is simple pro rata, and second is you do the valuation as on 1st of July 2027, and till that valuation, old rules. After that valuation, new rules. Okay. Can you ignore that one? I think we already covered this one, Rahul, in the previous.
Yeah, that's covered. Yeah.
Yeah.
Skip this.
So okay, just a third topic for now is a family trust. So we have done the negative gearing, we have done the capital gains, now the family trust. There are big changes happening on family trust, so just want to explain it. And interestingly, the family trust changes have been proposed from 1st of July 2028, not 2027 as everything else. So family trust, basically what they're saying is they're going to tax the family trust at least 30%. That's what they're saying. So they're not saying anything funny or anything, as simple as that. If family trust makes money, they're going to tax 30%. Only then it can distribute. How this is making a change? Imagine I have an adult son who is 19 years old, and I have a family trust and have a shares that is resulting me $10,000 of income every single year. Right now, I can give that $10,000 of income to my adult son because he doesn't have any other income. He's full-time college. It is possible for me to give that $10,000 of income to my son and practically pay 0% tax, because up to 20K-ish or 18,200, there's no tax in Australia for Australian tax residents. So given that my son is there, and then I'm giving that money for his college fees and stuff like that, and just to help him for the education. And he's one of the obviously prime beneficiary in the trust. So I'm allowed to give that $10,000 to my son. My son used that for college fees and stuff like that. But practically what is happening is my family is paying zero tax on that $10,000 of family trust income. In the future, once these rules are implemented, what they're saying is after 1st of July 2028, if my trust makes money, minimum tax I will pay is 30%. So that means out of $10,000, 3,000 will be taxed, and only $7,000 can be given after tax can be given to my son. So basically, my son will get a non-refundable tax credit. So basically, my trust cannot pay zero tax. The income has to be taxed at 30%. Now, I know I've taken a very small number of 10,000. Now multiply this number if you have a property in a family trust, if you're this and that. So all what they're trying to avoid is that nobody should be escaping the taxes using the family trust at least below 30%. So if your family situation allows you to pay below 30% tax, we're going to charge you 30% tax. That's what they're trying to say. Okay. A lot of people set up trust for asset protection, income splitting, estate planning, and stuff like that. By the way, when I've done a bit of modeling, trust for families with the kids and obviously spouses and stuff like that, for family trust seems to be still a preferable option when I was doing modeling, and we can talk in FAQs if required to, or Q&A if required to, but trust seems to be a decent option still after making a change, of course, if that change happens. Again, it's a very debatable topic, but we don't know what's going to happen, but they proposed from 1st of July 2028, 30% of minimum tax. Okay. There are some exemptions. So the tax is primarily targeting the discretionary, aka family trust, but not really targeting unit trust or widely held trust, super funds and all that. So they've been left aside. Obviously a few other things an exception, but for our understanding, it's if you have a discretionary trust, it's targeting that. And it also targets if you have a discretionary trust today or before the budget night, because in the future, what they're saying is from 1st of July 2028, no matter if you have the trust before or after, we're going to tax at 30%. Trust example, as we already spoken about, if 20K is distributed to adult kid, most likely very low tax, but in the future, $6,000 tax. You see why government wants to do that. Okay. What is understood by accountants so far is, you may have heard of a term called bucket company. That means if I have nobody to distribute the money, I can park that money in a bucket company and pay 30% tax on it. That thing, what government is saying is, what is understood by accountant is, if you do that, you will be double taxed. So basically, they are absolutely discouraging people to do that. So that means you won't be able to park the money in a bucket company. So if you have the bucket company already created for your discretionary trust, most likely it will be sort of a dead company or a dormant company, because you don't want to park any money in the future in that company after 1st of July 2028, if the rule passes. Restructuring window, they are giving, so once the rule is evident to us, they are giving a restructuring window, as I said, from 1st of July 2027 to 30th of June 2030. A lot of options will be given, hopefully, finger crossed, to restructure family trust into companies and fixed trust and alternative structures and stuff like that. Okay. That's okay. Again, what you should do now is do not panic and wait for the rules, and obviously keep attending some sort of educational webinars so that nothing should come as a surprise to you when it becomes a rule and stuff like that. FAQs. So not many, but I just have one FAQ for all of you, and then probably just one more minute and I'll shut up. So a lot of people are saying, okay, so if we have to now invest, should we create a company or should we go for a family trust? Lot of answers to this, lot of answers. There's no one set answer. It used to be, believe it or not, any account, you speak to any accountant before the budget night, and most likely they come up with the family trust option, and they are about 80% right, because it's no problem. Family trust is one tick option. 80% of the time it works for you. And then obviously after doing a bit of interview, 80% of the time is always recommended as a family trust, but not anymore. You literally have to chat to the clients about 15, 20, 25 minutes to understand the situation before that bespoke advisory we can given is a company or a family trust is a right for you. It's very different, but it's very important that you understand. With the company, what people are thinking is, we're gonna still buy the properties in a company. We're gonna sell that property. When we sell that property, we pay a tax of 30%, a flat 30% tax. We're gonna park that money in a company and we're gonna reinvest. And then we reinvest, and we will build a portfolio within the company, as in money portfolio within the company. And once we retire, we start paying dividends from the company and we pay a flat of 30% tax. And with the help of franking credits, will not pay any taxation. Whether they're right or wrong, no comments. Still workable, possible. For how many people will not need money when they turn 60 or 65? I don't know. When you want to retire, who knows? So many questions, so many open-ended questions. But one thing to remember is, when you buy and sell through a company, you do not get indexation. You remember that number 500K goes to 700K as a cost base, and then you're selling for 1.2 million or 1 million. So that indexation is not available to the company. Okay. But it is possible for someone to buy, sell, buy, sell, buy, sell, and only pay 30% flat tax rate within the company. But one more thing to remember is, the company money belongs to the company, not to you. If you try to withdraw all that money in the same year, there is a likelihood you'll have to pay differential tax of 17% as well. So a lot of planning needs to go in before you try to adopt this structure of company buying, selling, and all that. Okay. Again, the bigger question is, how do you take the money out of the company? Because that does not belongs to you. Okay. Obviously, what they're doing is, if you do invest through the trust, that's possible, no problem. When you sell it, yes, you get indexation, which is a big tick indexation for the trust. But what you don't get is, you don't get to park the money in any structure. You have to distribute the money to the beneficiaries or individual beneficiaries. So that means if I have an adult son and if I have a spouse, if we made 600K today from the trust, we have to distribute in this current financial year, the 600K of profit. There's no way to park the money in a bucket company or do something about it. We have to distribute that after indexation, of course. And that's pretty much it that I want to cover. Over to you guys. Thank you.
I'll just take 2 minutes before we start the questions. Look, no presentations complete unless we give those juicy deals as well. So I would like to quickly apprise with a few deals that we've done. I'm getting a lot of requests, Rahul and Ash, from a commercial perspective. No right or wrong, I'll let that work through everyone's situation. But this property, for example, has been bought at $1,075,000 recently, with a yield of about 6%. And apparently, from the agent's perspective, we bought this 150,000 less than market price. The tenant's been here for 5 years, and there's another 3-year lease. Now, the crux that we look at is, it's a high footfall pocket. There's a lot of commercial precinct, and apparently none of the commercial precincts have been empty. On top, there's a high quality works being done, which we've negotiated that as part of the make good clause, they're going to leave the HVAC, the flooring, and the ceiling as is. Now, and again, no market is complete unless they have Indian eatery. The second deal we've done is a small shop for $585,000. Apparently, they're accountants, so they've been there since 2017. So long-term tenants. There's another, I think, out of 5, 3.5-year lease still remaining. Again, the crux is high footfall pockets, less vacancy, and the yield is 6.2%. We've negotiated this property down from $625,000 to $585,000. This is against the notional mindset of most people that say the commercial properties cannot be bought cheap. And I know there's a lot of buyers agents who won't even pick your brief unless you have $1.5 million in debt. This is one more example where an office space on first floor has been bought. The only office space there was a lease in place. Everything else has been rented already, and the on a purchase of about 690 plus one-time costs, the rental is about $47,000 to $48,000 a year. This works out at nearly 6.7, 6.8-ish% yield, with at least a 3-year lease to begin with. So just few examples. And this property, the moment it's leased, we expect the valuation to go at 820 to 850. When I say moment it's leased, because we had to give about 3 months rent-free period as well to the tenants. So there's a lot that goes on, but just few examples. I will now stop the screen share, and Ash, over to you. We start with questions now. Rahul?
Yeah, we can just jump into the questions. And a lot of people have so many different questions. Again, the major question I think will be that how to distribute the profit from the company. Is there a way that we can do a separate bucket company where the money goes into, or what is the way to that? Because we have seen a lot of videos. Jack Anderson is posting strategies about what to do. Apparently, some of us things work, some of them it doesn't work. Ash, do you know anything about that, or any inputs on those?
Sorry, Rahul, I didn't get the question right. So what is the question again?
Like how to do, let's say if you buy right now, let's say family trust structure is not beneficial, you have to pay extra 30% tax. Now let's say you buy the in different structures, fixed units or companies where these thresholds are not the same. So how do you take money out of, let's say, a company? That is the
Right,
question you
okay.
kind of touched on. But again, is there a proper answer, or a different, like, not a proper is the right
Yeah.
word, but a better answer, which is shows us more direction
Yeah,
where what to do?
I'll give you a practical outcome. Sorry. I'll give you a practical outcome to this, okay? Practically speaking, again, lot of permutation combinations, guys. Please do not quote me on this one, but a practical answer is I'm buying a property today for 600K. I'll probably sell it maybe after 10 years. If I'm really lucky, the property gets double. That's what generally people tell me, that, property can get double in 10 years time. And if that is true, or if not double, let's say $1 million, only 400K increase for 600K property in 10 years time. Okay. I've sold this property for $1 million. Okay. Now I made a gain of 400K. The whole question is around how this 400K is taxed in different structures. That's the entirety of the question. Okay. And assumingly it's me and my wife, we both are full-time workers. Okay, so technically, let's say I make 150K, she also makes 150K. Just for a ease of conversation, let's say we both make 200K each. Okay, and now we have sold the property and we made 400K gain, 50-50 on an individual name. Basically, what will happen is, guys, if this property is in my individual name, I should be able to index or use the indexation or CPI. So maybe the property that I bought for 600K 10 years back, the cost base of that property could be 800K. If that is true, that means my capital gain is not 400K on my individual name. My capital gain is only 200K on my individual name, right? That 200K will be added to our income. So that means if I make 200K already, 100K from the 200K, which is 50% of my share, will be added to my income, which I pay 47% tax on, and it will be added to her income, and she also pay 47% tax on it. So that means on that 200K of capital gain, we are paying 47% tax, roughly about 94K tax on that 400K gain, if you understand that as an example. Okay. Now, let's take an example of a trust. If this gain is in the trust, yes, very similar. My trust has made a 400K gain, but I can use indexation, or I get a benefit of indexation in a family trust. So that 400K gain is now reduced to only 200K, and that 200K can be distributed to anybody in the family as long as legally possible. For example, it can be distributed to me, the entire 200K. It can be distributed to her, the entire 200K, or it can be distributed to any of our adult kid, or part of that income can be distributed to my parents if they're in Australia, and I'm supporting them financially. So I can even distribute maybe partial or full of the 200K to them as well. So this flexibility is available. So you see, there's no matter even, okay, even if it is to whomsoever I distribute, the minimum tax that I gotta pay is 30% on that gain. So that's what the trust is saying. So it's not saying zero tax, it's not saying additional 30%. All what it's saying is the minimum tax I will pay is 30%. Now, if you if you take this example that I've already made, so I'm already paying 47% tax, so which is way beyond the 30% tax, right? So once the rule clarifies, obviously we'll know the calculation, but most likely the indexation will be before the CGT calculation, and the CGT is calculated, or capital gains is calculated as 200K, and the 200K, if it is distributed between me and my spouse, I'm already paying 47% tax. So the 30% bracket is irrelevant for us. And in most cases, it will be irrelevant. So whomsoever you distribute, even if I give this to my, I don't know, to my parent, 200K to my dad, who's there in Australia, and then he will also be more than 30% tax rate. If somebody makes 200K in a year, they will also be. So generally speaking, all what they're trying to avoid is you should not be selling a property and not pay that 30% tax. So that's what they're saying. But roughly speaking, if you think of a situation, there will be very few situations where you end up paying, when you sell a property, there you end up paying below the 30% tax. So trust is still valid option from their case.
So
I'll
Ash,
just take, got
Sorry.
basically, they've said that they're going to tax at a minimum 30% either way. CGT of 50% discount could have been a short-term benefit, but now with indexation, the longer we hold the property, the longer, the better discounts we're gonna get over a period of time.
Yep. Yep. Now let's take an example of a company as well, where I've made a 400K gain. So indexation does not apply. So my 400K is entirely taxable. So straight away, the 400K multiplied by 30% is 120K. So it is possible to, yes, to buy the property in a company, and then I pay 120K in tax. So 280K can be retained in the company. Now that money belongs to the company, not me. So the company can go and reinvest if they want to. And if I have to distribute that money from the company to me, I have to do it in a year which is friendly. But if I don't do in a year which is friendly, it will add to my 200K of income. I will get a 30% franking credits, but I end up paying additional 17% on that income. So you see, I don't get indexation, I pay higher taxes. So there has to be a very good logic, a very good strategic planning with your accountant, why you want to buy a property in a company.
Yeah.
So
So now a lot of the investors who do this, as you briefly touched before, that they do family trust, discretionary trust, and a company holding. So in that scenario, is it still gonna be the same as with that? That's gonna be 30%? Or
Yeah,
because it's
so
being transferred to company and then maybe transferred to personal or other entity?
sorry, the family trust now cannot transfer the benefits to the company, the bucket company, which I've told you, because family trust itself will be taxed, let's say 30%. And then when you distribute the money to the company will again tax the same profits at 30%. So that's why there's a double taxation has been introduced or proposed. And that's why the end of bucket company. So no people won't be parking money in a bucket company anymore.
If that gets becomes legislation, which
Yes, of
again,
course. Of course.
yeah,
Yeah. Of course.
So, Ash, to that, there is a question asked by a listener. This
Yeah.
family trust income is taxed before it is distributed. Is
Yes,
that right?
to my understanding, yes. So what they're going to do is they're going to be taxing a 30% the family trust income, and they're going to be issuing whosoever is the beneficiary of that income, they're going to be issuing non-refundable tax credit to that person. So that means if the person is above the 30%, they will pay the differential tax. Let's say if somebody is on 32%, they will pay the 2% differential tax. If somebody is below, they won't be able to claim a tax back from ATO. It's different to franking credits. Now, franking credits, you can still claim the tax back from ATO. So that's the difference. That's why they do not call it a franking. They're calling it as a non-refundable tax credit.
Interesting. And there's another one. Does the 30% minimum tax, does the 30% minimum tax rate also applies for fixed unit trust?
No, no. So they're as I've shown in the presentation, they're exempted. So fixed unit trust means you are holding the units. So basically, if you're holding the units, the money will directly come to you like an individual. So it does not apply to the fixed unit trust for now.
got it, got it. So fixed unit trust, it doesn't apply to that. And we have more questions. I think this is for commercial properties. So Cheta has asked, with new changes, is it better to buy commercial property than residential properties? Is it something that you can touch on?
I
Ash?
cannot. I cannot. So again, I'm not expert into what you should or how you should invest into property. Obviously, we have property experts here, so I'll probably pass it on.
So I think rather than saying it's a good decision or not, Ash, just a question to you:
Yeah.
does the negative gearing limitations also apply to commercial properties?
No, to my understanding, they're exempt. Yeah, from the
Yeah,
new rules.
so I think on top, I'll simply add saying the facts which are on commercial properties, 90% of the time, the outgoings are paid by the tenants, which include your council charges, your repair bills, your even make good clauses, which means when they leave, they have to keep the property as is. Generally, there's personal guarantees involved and 3 months rentals, but then of course it's subject to a lot of checks. And looking at all of these things, your outgoings are fairly limited. In triple net leases, your property management charges and land taxes are also paid, but these properties are hard to find though. So overall, I don't know if it's right or wrong, but then you have much more benefits, but then there's much more risks as well. Now I'll leave it here. We move on to the next one.
Yeah. So the next one, we have a lot of questions from the group members as well, but we will just cover these ones first. We can touch upon those as well. This one is asked anonymously, if I release equity into a separate loan split and use 100% of the borrowed funds to buy Australian ETFs, example, WAS or A200, can the interest on that investment loan be claimed as a tax deduction? There is a second part as well. Also, is the interest deductible each year while I continue to hold the ETFs, or only when the ETFs are eventually sold, assuming all funds and transactions are clearly visible?
Right. To my understanding, again, I can come back to you on that one. But to my understanding, if the money has been borrowed to invest into an asset, you should be able to claim that as a deduction every single year. Okay, and obviously because it's a revenue loss or income loss, so you should be able to. And obviously, as and when the ETF's gonna make money, then you're gonna pay taxes on that.
And Ash, correct me if I'm wrong on the ETFs or shares. If there's a perceived benefit, you still have to pay tax. How does that works on shares
No,
and
no,
ETFs?
you don't have to. No, no. Only when you sell it.
Okay, it's only when
Only
we
when you
sell
sell
it.
it. Only when you sell it, because no, not yet.
All right, and then
No.
on SMSF, there is a guideline again. If the SMSF balance goes beyond $3 million,
Yes, yes, for the high income earners and stuff like that, but definitely not for probably most of the audience here. Maybe most of the audience is around 40-ish or around that. So very few people, or maybe yeah, very few people would have that $3 million balance each. So if you're a couple, then it has to be $6 million balance, which is again. So we
amazing.
not confuse the audience, yeah. Because moment we
Yeah,
touch that topic, then it goes to oh, I want to understand that 15% tax and this and that.
yeah,
You just
yeah, all
yeah.
good.
Yeah. Another question, Rahul. Let's go for another one.
Sorry, I was just saying that I think I was on mute. I was just saying that the SMSF 3 billion threshold individual, is that also indexed? Like by the time of retirement, if it's more than 3 million, and that is also indexed, or is it
No,
3
so
mils?
that's the funny part. Yeah, that's the funny part. To my understanding, is not getting indexed. No.
I think there was a rule again, and they
Yeah.
said it's going to be indexed.
Yeah, but
I could be wrong
I'm not
again.
aware
Like
of it,
I'm not an
Rahul, if it
expert,
is
but
rule has already passed. But to my understanding, it wasn't.
okay.
Yeah. To last thing I've
So
read is it's not. I think there was a lot of talks that why it's not getting indexed. But I don't know. I don't know if that is
There
already
was a
passed.
change after that. I could be wrong again, but
Okay.
let's
Yeah.
see.
So while we
Yes,
are on
yes.
SMSF, Rahul, there's a question by anonymous attendee. So what about properties bought through SMSF? Would an investor be able to claim negative gearing?
Right. So that's an interesting one. Again, without giving any sort of financial advice or encouragement or discouragement towards SMSF, just to let you know, SMSF is left out from this budget more or less. So basically, what they're saying is whatever you were allowed to do before the budget night is what you can do with superannuation in the future as well. That means just FYI, yes, it is possible to claim negative gearing before the budget night. In the SMSF, you are still allowed to claim negative gearing in the future as well.
Got it. Okay, so this clears it. Now, again, we have one more thing. Clarification required for new builds which has not received the occupancy certificate. Are they eligible? And number two question, What
Yeah.
about the new builds just needed and rented within the last few weeks? Will they still be eligible still?
So I think the new builds are very, very clear. Again, as I said, if you have probably in the building phase, if you've already signed the contract, and if you're before the 12th of, sorry, new builds are eligible for anything. So if you have a new build investing now, or if you have a new build before the budget night, you are still allowed to claim negative gearing. Is there a different question which I don't get it? Because new builds are exempted
No,
from
that's
this
I
new.
think that was
Yeah.
the confusion from them. Yeah, I think this is so new bills are completely exempt. There is no change to new bills. As long as you are qualifying the definition of a new bill, which we covered briefly before, you can just watch the video back and see what the definition of new build is. Would you like to touch up again on the dash, or is it like
No, I would
already in
just say that,
this?
new build, obviously there can be a lot of qualification as long as you have the new build is added to the Australian dwellings, number of dwellings. So you cannot knock down and rebuild the same dwelling or similar dwelling, or you have to do a multiple dwelling development when you are knocking down and rebuilding. So that's probably one of the questions that people generally ask. But overall, if you are buying a brand new apartment, if you're buying anything new, this all qualify as a new build.
So that answers it. How many times have you had this discussion, Ash, since the budget? All these questions you must know by the back of a hand. Like, yeah, this again.
Yeah, no, no, that's
This.
okay. Whatever I know, guys, I'm very happy to add. I mean, there are things obviously I will not know, which I will tell you, but most of the things are quite repetitive. So very happy to answer, no problem.
Yeah. The next one, property A is guaranteed for hearing and property B is sold with profit under the same entity. Can we adjust quarantined negativity, I mean negative gearing, amount of property A can be adjusted against the profit of property B?
Yeah, to my understanding, if sorry, I think there was a cutoff in the middle, but what I understanding is if you have a single trust and in that you have a loss-making property and a profit-making property, yes, you can offset it against each other, yes. And if you sell the property at a gain, you should be able to offset the carry forward negative carrying as well, yes.
Okay. Now we have
Which also
there are
brings to
some.
the interesting point. Let's say you have two properties and both are negative geared, and you sold one after 5 years in the trust, both properties in the trust, negative geared, you sold after 5 years, you should be able to offset all the negative gearing from both the properties from the profit that you made from single property after selling the first property. Right? So this can also be a cashing on that negative gearing carry forward for the 5 years. Again,
Got
we'll
it,
have
got
to
it.
wait for everything to clarify, but this from what we know, this also looks like this is how it's gonna be.
Next one is simple. There's some rule of 6 year of PPOR for CGT. Is that going to go away as well?
No, there was no mention on that, so hopefully that will continue the way it is. So 6 year rule still stands, but it's very tricky sometimes when you change houses and what you claim and what you cannot claim. Obviously, remember you're only allowed to claim one PPOR at one point in time. Just because you moved into a new owned property, if you don't intend that new owned property is your PPOR, you can still classify the previous home as a PPOR.
So how long do they have to live in their property to be able to do that? Let's say if I
Roughly
lived in this
6 months.
property
Six
6
months.
months, 6 months is the time.
Roughly,
Got it.
roughly speaking, depends on state to state, but roughly 6 months.
Okay, that answers it.
And intention as well, Rahul. Intention has to be living in that property forever. It should not be a strategy that I will gonna live 6 months and I'm gonna quit. So the intention has to be like school admission intention, everything has to be there. Not if you just have two mattresses and you say I will sleep in there and you actually do sleep for 6 months, that does not qualify because your intention was always live there 6 months and then move out like that. So you have to have an intention to live in the property as a PPO.
Got it, got it, got it, got it. Next question. Anubhav had asked, would the transfer of the title for a newly built property qualify for negative gearing? For example, if someone purchased a house and land package a few years ago, the construction has not completed and the property has never been occupied. If the original seller sells property to a new investor before anyone has lived in it, would the investor be eligible to claim negative gearing benefits when the property is rented out?
Yeah, maybe drop me an email on this. My email address is ash@cleartax.com.au, and probably I need to have a lot more details as in date and transfer and who owns the property and what is the how if the house and land, why it was not constructed and what is the reason and stuff like that. So there can be a lot go in, but as long as there's a new dwelling added to the Australian market after 12th of June, sorry, 12th of May 2026, most likely that should qualify, unless there are other reasons to say why not.
That's very interesting one because I've had a case where the property wasn't directly with the builder, it was with an investor. Now the investor bought land few years back, and of course there's benefits on the land as well. Now they want to build it and just sell it. So my understanding was it just is in that gray area where where we were unsure whether the buyers we were working with whether they would get the benefit or not. So we rather stepped out of that property
Okay.
just
Okay.
so we don't land
To
into
my
any trouble.
understanding, if the occupancy permit has not been issued to anybody, and I think so, what they're giving is if it is with the builder as well for the first 12 months, even after the occupancy, it can still be sold as a new property. So to my understanding, in 99% of the cases, this should qualify as a new property. If the construction has not started or construction has been started and still under construction, if nobody has lived in that, that should qualify as a new property.
Interesting.
Yeah,
Okay.
that's what I
Thank you
read
for
as well.
answering.
I just didn't want to jump
Yes.
in that. But yeah,
Yeah, there
that's
was a 12 months window as well for the
12 months window
yeah,
exactly.
12 months window.
Okay, got it. So next one, I think this is more financial planning sort of question. Again, Michelle, clients, again, Michelle, depends on what you mean by clients, like what's your occupation, what's your profession. So you have said clients are now choosing ETFs over property after the budget change. What is your take on this option?
Definitely, this has the whole budget has made people thinking there is something called beyond property investments as well. So definitely, we are seeing a lot of inflow of people talking about diversified portfolio, but I've not seen many people saying no property at all. Again, up to them how people wants to, but again, as a financial advisor, one would educate their client to have a diversified portfolio. So definitely this budget has educated people, especially a limited growth in the property sector has educated people that there are other asset classes as well that you should focus on. But again, property is one of the very popular asset class by default in Australian market.
Well said. You should always diversify a little bit anyway, even though once set is very strong,
Mhm.
it can change anytime. The
Yeah.
policies can change as we saw that happen. So
And I think
diversification.
this time also the all the asset classes are impacted as I understand.
Mhm.
It's not just
Mhm.
property or one asset class for that matter.
Yeah.
Um,
Hmm.
the next one is from again anonymous attendee. If my current PPOR is principal place of residence, is a townhouse of $900,000 under the government's first home buyer scheme. And instead of investment, if I'm selling this townhouse and upgrading to an independent house as my PPOR, which is priced around $1.7 million, do I have to pay tax again on the sale of townhouse? Can you please suggest and guide what is the best tax strategy? I'm confused.
Okay, so I'll try and answer my piece, and then probably Ashish
Yeah.
wants to. So my piece again. I don't know what is government scheme that you are under and how that is. Maybe there's a clause for 2 year living in the property and stuff like that. I'm not
I
sure.
don't think it's going to be relevant in this case. The government scheme is to get you in the house, live in that for 6 to 12 months, and then you are able to claim this. If you're selling this, I don't think it's going to impact. If you are making it an investment property, that can be a concern with the government scheme. And again, I have not personally seen, because I help hundreds of clients get into first home buyer, a lot of them changed into investment after 12 months. That's a timeline government says. But selling, I don't think it's an issue because people can sell for multiple reasons. Some of them cannot afford the repayments and sell the property. Government cannot come back and claim it back.
Yeah,
To my
so
knowledge,
yeah,
the solid
yeah.
solution
Again,
as well.
you are allowed to sell your PPOR, technically speaking, after n number of months, and then as long as the intention is right, you should be able to sell your PPOR and then buy another PPOR. Obviously, the stamp duty is still applicable to you guys, but generally the taxation is not applicable or the capital gains is not applicable because it's exempt. PPOR is exempt from CGT.
So Ash,
Hmm.
if I clarify this further, so let's say I buy a townhouse for
Mhm.
$900,000. I live in it for 12 months, sell
Mhm.
that for 1.1 million,
Mhm.
just as an example,
Mhm.
and then buy another owner occupier property for
Mhm.
1.7 million.
Mhm.
And also stayed in the new one for 12 months. So
Mm.
if I'm understanding correctly, that
Mm.
200K is tax free.
Mm.
I put that in my owner occupier,
Mm.
and now after a year, my owner occupier is $2 million.
Mm.
So this 300K is also tax free because at a time I'm only claiming on one property,
Yeah,
CGT
yeah, yeah.
benefits.
That's tax free. Yes, there's no problem with
Ama-
that.
Amazing.
Yeah.
All right. So I
Just
think
a
this
twist to
is,
the same question. Sorry, just a twist to
yeah.
same question because I'm seeing this scenario a lot now. People who already have a PPOR and they want to buy in like another one, and they're trying to convert that current PPOR into investment and claiming negative gearing on this. So can that be done, Ash?
Yeah,
Just
yeah.
from your
Yeah,
perspective?
so this is one of the very popular questions that people say that if I have a PPR today after the budget night, can I convert that to investment property and start claiming negative gearing on that? To my understanding, and to whatever the researcher says, yes, it's possible. It should be possible. Again, the clarity will be in the due course, but from what we read now, it should be possible.
So Ash, I've also got a hallucination where, and it's over hundreds of conversations, I have learned or I've seen most clients or most
Mm.
successful clients keep their investment portfolios separate and an owner occupier line separate. What I mean by that is they keep on churning, like buy one, sell it, upgrade to a better one. And by doing that, a client has moved from literally a 900K property now to almost a $3.6 million property. And he's got a separate investment portfolio. Alternatively, there are people who will, of course, because they want to retain or they have some emotional value to the home, they convert it to an investment and then upgrade. How do you see that difference? Because one
Yeah, there's no,
understanding, yeah.
yeah, there's no right and wrong to this, Ashish. Everyone has their own strategy, their own mindset and stuff, and their own partners to make a decision because it's very emotional decision where you want to live, how you want to live. A lot of things get influenced, including the school education for next, 12 years and stuff like that, and selective schools and
But
maybe
if
private schools and stuff. So a lot of things get impacted when you make these decisions. Obviously, all this is a private conversation that you will have with an accountant to understand the taxes, but you will still discuss it probably with your property strategist and start making those decisions. What happens for what? Uh, an accountant and advisor would have a very limited inputs to this because you are actually choosing to live or to move in a higher gearing structure as well as moving away from your emotional home. For most people, they're buying a PPOR is emotional rather than a financial exercise. If it is financial, most people may not buy even PPOR because it's sometimes it's just too expensive to hold off. But it's emotional. So I would generally say PPOR is a personal expense, and it's a purely personal decision whether you want to live in 3.6 from a 900K home and stuff like that. It's very very
Good
personal.
point on that, Ash. And there's a very related question to this because, as you mentioned, it's like not a financial exercise, it's an emotional exercise, which brings us to rent vesting as well. So now a lot of people are like confused between is rent vesting still a good strategy? Is because the negative gearing tax benefits was a big part of the spiel that rent vesting will get you tax benefits, capital growth, buy where you can afford all these things. Now that is gone. Is that still a good strategy that you can think of? Is that or tax changes are going to make any impact in this?
I think I mean, rent vesting has always been populated towards aggressive investors. But still, I would say a couple would always target, or maybe a 60 to 70% of people will always target a PPOR for everything else. A PPOR is more stability, and then go for an investment property and stuff like that. I see I have when I speak to people, I see rent vesting it's there, but I don't see it's again very very popular as a PPOR. So everybody probably wants to bank on that PPOR stuff, irrespective how expensive it is, and then go for rent vesting. And people who are actually subscribing to say mentoring programs or speaking to buyers agents or speaking to so they do get concept of rent vesting, and probably they get mentally trained that it is also a strategy. But most people, as you know, that they make a decision of putting that deposit for their first home, and the government is trying to obviously push people towards a PPOR as well. So probably you will see more sort of a people inclined towards a principal place before they go on investment property.
There's a good side to argument for both of these.
Yes, of
For
course.
me,
Yeah.
I'm a numbers guy. It just comes down to numbers.
Yeah.
If you can buy a house in Sydney, let's say if you live in Sydney,
Yes.
for 120, 125,000 with 5% deposits, let's say 1.5 million is the house you want to buy. 75,000 is the deposit you need. 50,000 is a stamp duty, so you need about 125. That is one option. You are not paying LMI. You are building a CGD free asset for $1.5 million. Your other alternate is to buy negatively geared property in a different state for 600,000, pay 20% deposit, 120 plus 30,000 stamp duty. So 150 by saving LMI, you are still buying an asset which may be possibly a good choice for you. But for families, you can also buy a 1.5 million asset in Sydney if you live here. So numbers play a big part in this because in Sydney rent is high. So if I'm paying 4,000 rent and I can save that, buy a 1.5 million asset with the same amount of money, why would I not consider that? It's still asset which is gonna go up in value, which is still gonna be CGT free, while I have to pay CGT on other things as well. So when I run the numbers again and do some modeling as you do, I didn't as well. I'm an investor. Objectively, if I'm able to do this, PPOR made way more sense than
But
rent vesting.
Rahul, I think the crux here is on a 1.5 million property in a loan of 1.4 million, I'm paying approximately around 8,000 a month in outgoings, which will not happen in case of an investment property. More importantly, I believe the discussion also is which state you are living in, because I would pay 60,000 in rent, then spend 2.4 or 2.5 million in a property, still owner occupier. Alternatively, if you are in Melbourne, for example, Ash, you are still able to buy 40, 50 kilometers out, properties worth 700-ish, you're much better off buying a home because you're claiming all those benefits, which are actually really worthwhile, not paying stamps and claiming and if you have a brand new property, you're claiming some building grants and whatnot as well. So I think where you are staying also forms a big part of um, what you're buying and what your capacity is and what your holding costs are and what your outgoings will be and are you comfortable paying those outgoings or not. So yeah, these are few considerations I
Yeah,
would give.
it plays a big part in your rent is what the numbers are, what are you going to get out of this. But if I just do numbers to numbers, CGT after that, what I'm getting out of this, considering they both are going to grow up the same 8% rate each year, after 10, 15 years, you are better off buying in PPO rather than rent vesting. Again, I say that as a rent investor, I rent here and buy whatever I do in property investment interstate. But now things could be different and you may be better off running the numbers rather than just going by what everyone else is saying. There is no right or wrong. It's going to be coming down to your individual situation. It's a really good question, this interesting one, I think.
Absolutely. Awesome. Further on, Prabhakar asks, thanks for the detailed information. And do I really have any other options to pay my mortgage? Sorry if this is irrelevant, other than buying IP. Um, I think what they're meaning to say is previously people used to buy investment properties, and with the growth, I believe one of the goal that I used to hear a lot of times was I would like to pay off the debt on my owner occupier property. So I believe this question is challenging that aspect that now with all of these changes, is it really worthwhile? One, to buy an investment and still expect the same, and second, if there are any other ways than robbing a bank.
Yeah, only thing I would say is in this one, if you look at the bigger picture, I'm buying an asset. I want to go from A to B. That means I'm buying an asset for, let's say, $500,000. I want to sell it for $1 million. I want to make a $500,000 gain. That mentality has to be there when you invest into an asset. Why we are even so much bothered about negative gearing, or why we are letting our negative gearing of delay of negative gearing, it's impacting our decisions, because all what you're saying is I want to make what you are trying to say is I want to make a loss on this property year on year. That will keep me happy. How can a loss making keep you happy forever? You should ideally be thinking how this property is turning into positive gear ASAP, so that I'm not making a loss anymore. And technically speaking, guys, I mean, obviously we are looking at 6% interest now, 5.5, 6 or 7% interest now, but sooner or later the interest should drop down as along we have some sort of stability in the market. We don't know. Probably economy has seen a lot of examples of high interest rate and then probably dropping as well. But I don't know when. But once it's dropped down, then we are discussing whole together different discussion. All my properties are positive gear on my personal name. What should I do? Because this is what has happened in most cases before COVID, right? So it's not impossible to happen. A lot of people have enjoyed it. So please let all of us focus on how do we make money from the property, not how do we lose money and then save 40 cents of a dollar from negative gearing. So probably the mindset shift needs to happen with all this. And then once we have this mindset that eventually my target is to make money from this property, and when you make money, you will be liable to pay taxes. As
And
simple as
as
it.
and as you've hit the nail on head. I get asked a lot of times, is property investing dead? And this is people saying that brand new properties will be bought and they'll grow in value, but established properties won't. And I think there's a good negative argument to this statement as well. However, what I've seen in Sydney, for example, and I'll not generalize it, but I'm telling you because I've talked to a lot of developers as well. The government is deterring investors now to sell their assets because if they cannot claim any further negative gearing, that's also what's going to happen. Maybe short term, you'll see few properties on the market and then those properties would fade away. Brand new properties, you're looking at buying 50, 60, 70 kilometers out and still spend $800,000 on a townhouse. Not a lot of people would even look at that as an investment. Then the building costs have gone up by 40% in last 3-4 years, which has the build to rent. The government is not giving any benefits. I think now they're talking to take the land tax off, but build to rent, let's say an apartment building, $500,000 for build, 80,000 for contributions, and add another 30,000 in cost. So before even the apartment hits the markets, there's $610,000, which a developer can't even cope the cost in terms of rent, and then there's so many outgoings. This is deterring the developers as well, and now the developers are saying if the apartment number is not at least 60 or 62 is the number, it doesn't make sense, which means all smaller developers have now gone out as well. So by doing all of this, there's going to be no rental stock. The rents would go up, which will push the prices up further. There's a good argument, whatever you buy now is still going to work in value. It's just that the negative gearing, you're not going to get benefits. But I don't think there's least association to growth. But anyways, I won't take much time, but that's what my understanding has been after listening to a lot of podcasts, reading through the tax guidelines, and talking to so many developers. Yes,
So we
just
will
over to
take
you.
the questions which you already answered, similar questions we will skip, and we will just cover the last three, which are standing out and which are different than others. So again, Ashish, which one do you think are like, standing out? Because we have like 50 different questions right now. We just cover last three. Would you prioritize cash flow, capital growth? How the buyer activity in the market? So buyer activity is going strong still.
Yeah.
It's reduced obviously a little bit, but it's like people are planning strategizing. May, June is the usual month, slow months, because people wait for financial year to end, and that's when they buy. Combined with interest rate hikes, inflation, May end, financial year end, it's obviously slowed down, but it's gonna pick up, I think, again in July, August, and that's when we will see the real impact if it's happening or not. Again, we have so many similar questions. Now, which three would be the best, Ashish? Can you just fix and clarify?
Rahul, the list that you have sent, number 4, if family trust, discretionary trusts are going to be taxed for distributions. Oh, okay, I think that's covered. Should we
Yeah, I
buy
think
under
we covered that.
company?
That's right. A lot of them are repeat questions, and you can just
Then
cover
Sumit
these
has
off.
asked, thanks Ash for the presentation. Are we saying that if we have paid 120K of tax under company, 30% of $400,000 gain, can we claim credit of entire 120K spread across different years if I release that 120K amount in a very systematic way?
Yeah,
I didn't get that.
yes, to my understanding, yes, possible. So technically, let's say I'm only paying 20K of dividends for next 30, 40 years to me and my wife, and we both are the shareholders of a company. It is possible to get a franking credits back from ATO and end up paying zero tax. Possible, yes.
Good. Yeah, now that's good. Kai Mio has asked a few questions. Kai, we have covered these questions into the webinar, into the session. So we will just send a video to you, so you can just go through them, and a lot of them are covered in there. So we will kind of skip these for now. Ash is also like running out of time, so we need to be quick. Again, I think it's mostly the similar questions. Does CPI rules apply for losses as well over the years? We already covered that indexation is going to be part of that as well. Is it true, Ash?
Sorry, I didn't
for
read the
losses?
question, but what I would say is, guys, I mean, not to be worried. I am here. I'm very happy to answer. I've dropped my email address, the phone number, and the booking link as well. If you want to have a quick chat as well, there's no cost to it. Feel free to book me in one-on-one as well. Very happy to listen to you personally and happy to answer those questions as well. And I mean, first preference, you if you want to book your accountant, feel free to. If you feel like no, it's better to have a second opinion and stuff like that. Very very happy to. So you
We
can
will
you can
send
use all that.
Ash's
It's in the
links,
chat box. Yeah.
email address, link, everything. You can get in touch directly and ask all the questions that you want. And we will just cover the FAQs now. Ash, do you have any inputs that we have missed that you feel like mostly common scenarios or you may have faced? Let's just end with one or two of those things, and then we can just end the session after those things, which you have feel like me may have not covered yet.
Yeah, absolutely. I think so. Everything important, Rahul. To be honest, I've tried to include that in the presentation. I do recall and stuff. I understand it's a lot to take in that very short span time, but I do try to cover everything that was important. Again, when you're buying a property, the three things will come into your head was a, a trust structure, a company structure, an individual, how you should go about it. Obviously, the things will be like preserving the borrowing capacity, a separate asset protection because of separate legal entity concept and stuff like that will come more and more evident. But one thing generally people forget is land tax. Now, it's very important to consider how much land tax you will be paying if you go for a structure. Now, just giving you one example, that is one thing that we have not covered. Again, this is a tax tip rather than a budget tip, but again becoming very relevant. Say, for example, if I choose to buy any property or every property in a family trust, and if I go in NSW and try and use family trust to buy a property, there's a possibility there's zero land tax threshold for family trust. Vis-a-vis, if I buy it from a unit trust or a company, I may get $1.075 million of land tax threshold. That means if I buy a 600K home in Sydney or NSW, it is possible I end up paying 5 to 6K in land tax every single year for the rest of the life of the property that is under my name or that is under a family trust name. So don't miss out on that concept that you need to check a land tax before you buy a property in a structure.
Sorry, I just want to cover one thing which we missed in this. Let's say you mentioned something about 3 years to restructure. Does that mean we can go from family trust to personal, other trust, companies? What do you mean by that?
Most likely, yeah, most likely. So generally, probably the option will be given to structure out of discretionary trust and moving into a unit trust, a company or individual. Most likely that's what happened. So if you
Oh,
already have a property in a trust, and if you feel like, oh, we were taxing, the government is taxing discretionary trust, if I know this information, I would have structured it differently. Most likely the government will give you option to move out of a discretionary trust.
yeah, this would be fair because everything is grandfather. There should also be a way to do change this. But this, I think, answers most of the questions, all of the questions that we have. Thank you for attending and taking time out for this. I know you're very busy and you have like family to go back to as well. So we will conclude this session here. If you have any questions, we will send an email shortly. The video link, Ash's details, all of these things will be sent to you soon. All of those who have registered, feel free to reach out to him, spam him, or just get in touch with him for any more questions. Thanks,
Thank you, Rahul, and
Ashish.
thank you,
Thank you for
Ashish, for
attending.
having me.
Thank you for taking time out.
Awesome.
Thanks
Thank you so
everyone
much.
for decisions. So once again, thank you for joining. It's 7:30 today. It's gonna go on for at least 1 or 2 hours today. So thanks for taking your precious time to attend this event. We have quite a number of registrations and a lot more people are joining in. We have Ashish from Oswald Bias Agency. He's a bias agent. And if you don't know me, my name is Rahul. I'm from Fin Matters. I'm a mortgage broker. And with us today, we have a really special guest. His name is Ash Jindal. You would have seen him before. If not, he will show what he can do today. He is not only a tax accountant, but one of the only few people who also has financial advisory license. Is that right, Ash? I think you're on mute, Ash.
Thank you. Yes, yes, I do. I do.
No, that's great. That's great, Ashish. So, Ash, if you can just like let us know a little bit about yourself so people have some context, how long you've been doing this, what you do. People who don't know who you are, obviously they might have seen you on YouTube or the social media, but please.
Absolutely. Now, thank you very much, Rahul, and thank you, Ashish, for giving me this platform. Very, very excited and very happy to introduce the budget or the budget changes to everyone. On a lot of, it's more like a discussion. Obviously, we can do heaps of time for Q&A. My professional background is I'm a chartered accountant from Australia, New Zealand. I'm also a registered tax agent. I'm also a registered financial advisor. I run a practice called ClearTax. We are 102 people we are 102 people in the firm now, approximately present in 6 locations, including Sydney, Adelaide, and